Hi, welcome back. And this one follows on from my video about the attention seekers that we find on social media. Again, it links to a Substack article. The link will be in the description, and don't forget to subscribe. So when we look at the many accounts that are supposedly giving us, valuable market analysis, one thing that you'll find is that they'll be categorized into their different niches. And what I find very interesting is each of these niches kind of suggests to us that their little niche is going to tell us where the next crash is, where the next, where the moment of weakness is. And I guess this is how they get subscribers in. It's all about that attention, right? And obviously being able to predict the next crash is something that, everybody's looking out for, even though they happen very infrequently. So, for example, if you look at gamma accounts, they'll tell you that they're analyzing on the areas where there's massive short gamma of dealers allegedly is where the weakness will be. And if you look at VIX or volatility accounts, they'll tell you that their indicators, looking at the VIX index or the skew index or some sort of volatility analysis, that's going to tell you, that's going to predict where there's weakness. That's going to tell you where the next crash is. If it's somebody who looks at central banks around the world, they're going to tell you that they know where the next crash is going to come, and by looking at the central bank activity and balance sheets, etc. And what you find is they all think that their indicator is going to tell you where the next crash will come from, where the next big correction or moment of weakness comes from. So which one of these is right? What should we do? And the reality is that none of them are right. And what we have to understand is, if you want to understand a picture, you've got to look at a wide variety of information. And the best tools that you can use is to build yourself a very good watch list with as much information as possible. Continue to educate yourself about different markets, different conditions, and understand that even an indicator, a tool, or some market data that might have been helpful 5 years ago, the last time there was a correction, or so forth, it might not be the area that is going to give you any kind of advice or forecast or confirmation of the next one. And that's why it's really, really important to remain open-minded. And when you focus too much, and I think a lot of these accounts are guilty of this, when you focus too much on one little niche, one area, you create a huge blind spot to essentially everything else around. It's almost like having a short put option on any other kind of information. And you really have to continually look at lots of information. And the idea that one area is going to tell you anything, or everything, is just not going to happen. So part of our job when we're trading or investing, continuing to monitor as many markets as possible, continue to educate yourself on as many markets as possible, build watch lists, watch how things are interacting with each other, understand that this is a continual learning journey. And just because something was interesting or profitable or popular in the past doesn't necessarily mean it's going to be useful next time. Some example, one, clear example comes to mind is, everybody was watching the Baltic Dry Index around the time of the GFC, and they saw that, absolutely plummet. And that was a sign that world trade was slowing, and perhaps it had some relevance then. But since then, it's kind of lost that predictability of global recession, right? And, sometimes bits of data can be useful at that moment and perhaps never again. So that's why, again, we must try to eliminate blind spots and be on the lookout for as much as possible. When you go down this indicator thing, avenue, or they're really rabbit holes again, you can end up paying for subscriber services of so many of these things and hoping that, which one's going to be the right one. In reality, you could end up paying a lot of money for that, right? In reality, just build a watch list. They can be done, reasonably cheaply. There's some free services out there as well where you can build watch lists and look at lots of different markets. Try to put the picture together. Remember to try and approach analysis of markets from the perspective of weaknesses of the participants and known weaknesses, ones that you can know of. So, understand the reflexivity of markets. I discussed that in an Into the Bull. And what that means is that if participants are positioned incorrectly for any particular news or particular event, that's where weakness can come. Now, for example, gamma accounts will tell you that the market makers are way short gamma on any move below, 4, 5, 6% or lower. Some of that, the assumptions behind it, as I've said before, and I write about in my options course, they're not necessarily correct assumptions. So be very careful about those ones. But where we know, for example, most equity investors are the long side. When you know that, you can start to see where their positioning might be weak. So any analysis of where there could be problems needs to come at this from the perspective of reflexivity, from the perspective of where are the participants, where is their weakness, because that's where there could be trouble. So that's what we need to do, build watch lists, continually re-educate ourselves, learn about new markets, and try to figure this out, and not just focus on one indicator. And by the same token, be careful just to keep subscribing to lots of different ones at lots of different fees, and the real answer may not come from any of those. So be open-minded about it and don't create blind spots.